Why do governments keep buildings full of gold? Yeah. And there's a very simple answer. It's not a very happy one, but it's a very, very simple answer. Gold is for war. If you're, one of the sides at war right now, no one's going to take your little printed pieces of paper with IOU written on it. No one's going to take your government bond. Are you going to take a Turkish government bond? No. Are you going to take an African government bond? No. If they want to buy something, they've got to back it up, and that's the dollar, right? So you haven't got dollars, you've got to pay with gold. Yeah, gold is for war. And now, see, 6 months ago, I was looking at the chart and I thought, it's not going to go past, 2.6, 2.8. That's about the limit on this chart on the upside, which is pretty good if you've got a fairly large amount of gold. But now it looks like it could go to 5,000.
Hey guys, welcome back to Capital Cosm. Today, I'm thrilled to have Clem Chambers on the show for the first time. Clem, thank you so much for coming on, my friend.
Yeah, it's great to be on. I saw your show and I thought I've got to be on that show.
Oh, well, thank you. I appreciate it. And it's always a pleasure having new guests on, especially like yourself, Clem. So very happy to have you on. But before we get started, guys, I'd like to remind you to check out our Substack, capitalcosm.substack.com. A portion of this interview will be exclusive to Substack members. So be sure to click on the link down in the description box and the pinned comment down below to get the full swath of this interview, as well as the ad-free experience as well, among a number of other things that you can see in greater detail on the Substack. But with all that said, Clem, let's just dive right in. This is your maiden voyage on the show, and it is customary for me to ask, what is your origin story? How did you get to analyzing the markets and the economy and all this stuff that we talk about? You've been doing this for 20 plus years.
It's a very long story. When I was a child, I started a computer game company in the UK. I was one of the pioneers, and it kind of, parlayed on from there. I then got into massively multiplayer games before anybody knew what that was. And before anybody knew what that was, I then floated some stock market companies in the UK. Went through the dot-com boom, and as I was going through the dot-com boom, I started a financial website, which became very, very popular. Your American listeners will know of Investors Hub, and the company that I floated in the UK acquired that company, and off we went. So when I started doing it, I thought, well, if you're going to do an internet site properly, you've got to have skin in the game. So I took all my money and I put it into stocks, because we had started this stock market website. And I thought, well, I can sit there and just be a manager. Oh, do this. Oh, do that. I have no idea what I'm talking about. I don't do shares, but carry on, people, build a stock market website. Instead, I just put all my money into stocks. And then I was in a situation to go, oh, what's going on with that share? Oh, what's the news on that? Oh, what's the price of this? What's the level 2 data on that? So, my rear end was my soles of my feet were to the fire, or whatever part of the anatomy was under stress, to actually make sure I didn't lose my shirt. But I had a little bit of an edge, because when I was a child, my father was quite a successful commodity speculator back in the 70s, when commodities were absolutely wild. So I kind of experienced that I suppose I would have been about 10. So I'd come back home from school and I'd say to my father, Dad, how do we do today? And he would say, oh, well, we made £50,000 today, which was a hell of a lot of money. A Jaguar, an English car, which some of you might know, was £2,500. So it's the equivalent of basically he'd made 20 Mercedes-Benz that day. And I'd come back from school the next day and say, how do we done today, Dad? And he'd say, oh, we lost £100,000 today, son, which would be, I don't know, 2 or 3 million today. So that was my daily routine coming home. How have we done today? Oh, the market was a bit firmer today, and we made £15,000, and so on and so forth. And he would let me listen to the commodity rings on the telephone on a special extension that only had an earpiece. So when he was on the phone to his broker, good old days when you rang up the broker in the morning and at lunch and at night, I'd pick up the phone and I would listen to his broker, and they'd be talking about the ring and selling it on the ring, and there would be the curve and all that good stuff. So at a very early age, I got a taste for the market. So I was kind of imbued into what was going on. And he wasn't very keen on stocks because they moved so slowly and they were so boring and you couldn't get leverage. Whereas in commodities, if it went up 10%, you doubled your money. So you then sell your position and double up and double up and double up and double up, which is utter insanity. But he wasn't to know. and he did very well out of it. And I was there listening to that. So at a very early age, I bought my first share when I was, I think, about 8. And it was
Wow.
a company called Metramar Minerals, an Australian gold mine. And about 3 years ago, I saw a press release about a mine in Australia called Blue Spec. And I remember from being 8 years old that Blue Spec was Metramar. So I wrote to the CEO and said, come on now, when I was 8 years old, they were pumping this blooming stock. And now, 50 years later, you're telling me that you've got a great gold mine and it's Metramar Minerals. And he actually sent me a letter back and he said, yeah, I know, but they had 4 ounces a ton then. And we're going after 4 grams a ton, which is left over from that. And that's a really good grade these days. So bless him. He didn't kind of run away from this lunatic that was writing to him 50 years later. And but that's kind of a legacy that I had. So I had an advantage. So when it came to 2000, when I'd come out through computer gaming, because the reason we got into stock market information was, as far as I was concerned, it was a massively multiplayer game. It was just the massively multiplayer game. So it was natural to go from, games that were multiplayer and parlay all that experience that I'd had into the biggest game in town, which was the stock market. So I got several, streams going into that, and then basically built the site. It became very successful, and here I am. And to actually push and expose our brand in this desert of noise that is the interwebs. I went out and started to do CNBCs and Foxes and Kitcos and all that good stuff. Wrote a few books on the matter, which became bestsellers on Amazon, and built up over a period of time a pretty good legacy. And I've had some very, very good results, and I've written for. I actually used to write Wired magazine's money column back in 2000, and it used to showcase some three-dimensional tools to value stocks with, and so that's kind of where I've been for the last generation.
Let's talk about the biggest online game out there, which is the stock market, the market in general, right?
Yes, that's why I'm here.
What is your prognosis of the markets right now, as well as the economy? And they may not be, oftentimes people conflate the two. The economy is not the markets, and the market is not the economy. So if you can kind of like parse through that, what do you see from a broad stroke perspective out there?
Well, the perspective, there's so many moving parts. So what you really need is the big picture. Okay. And the big picture is the market looks out 1 year. So where the market is today is where people think the world will be in a year. Because after a year, people, I don't care about that. A year is about as far as the group mind can think or wants to think out. So the further away you get a sort of curve of probabilities. It goes, a year is where the price is. Oh, no. Further than that, nobody really cares. Right up close, nobody really knows. But they can see kind of where it's going to be. So the hive mind is thinking about a year out. And that's where the price of assets has about a year's worth of developments kind of folded in of what people can calculate. Obviously, if you get hit by a meteorite, then you can't predict that. But the probability curve brings the price of things today to about a year out. So people are seeing a year out is where the market is right now. So that suggests that, if you actually look at the way the market's behaving, that we're on a recovery from the absolute economic disaster that was COVID. And, the authorities, the central banks particularly, papered over that utter disaster. And they papered over with the classic paper overing of inflation. Because if you print a load of money, nobody today realizes that it's going to eat their wealth over the next 2 years or 3 years or whatever. So when you look at the vast debt that's been built up globally, you can see that there's really only one way out of that. And that's not to cut budgets, and that's not to, kill investment in armed forces and healthcare and social services, etc. It's actually to tax people the simplest way known and the easiest way known, and that's through inflation, because inflation is a tax. Now, they won't let it run away, and they have brought it down. But if you really kind of want to feel your way where the real inflation really is, it's quite a bit higher than the official numbers. And if you actually do lots of research, it's very difficult to measure inflation because, for example, cars are much better than they were. And they actually say, well, cars are much better than they were, so they're actually a lot cheaper. And all that sort of nonsense, which covers up the real rate of inflation. So if you look at, say, the first car I ever bought in 1983, it was basically 500%. It's gone up 500%. So the cheapest car you can buy today is 5 times more expensive. But if you look at the inflation, the so-called inflation numbers, it should be 3 times more expensive. But it's not. It's 5 times. So if they kind of say inflation is 2%, you can guess that it's 4. If it's 3, it's 5. Yeah. So if you have real inflation at 5, it does eat away at those big debts. If they can hold up the other end of it, which they probably won't, because they'll just take advantage of that leeway and spend it, because unfortunately Western politicians are absolutely financially incompetent and incontinent and spendthrift people. But if they were somehow to get a grip on the finances, they could, over a period of, say, 10 years, rebalance the shit. So what you're actually looking at is there's going to be elevated but not runaway inflation, say 5% real inflation. And that inflation goes into assets. It can't not go into assets. The only way assets won't keep up with inflation is if somehow they're made cheaper, which of course technology will do that, but not that quick. Yeah, so you're going to have assets go up, or rather the value of money will go down, and therefore the numerical value of assets will go up. So you could look at gold and say, well, it's gone up all this way in all these years, but actually it might still actually be the same price. It might still actually buy you the same amount of haircuts as it bought you in 1842. So it's only a hedge or a defense against inflation. And the difficulty with inflation is hard to outrun inflation. It's easy enough. Well, it's not easy to keep your head above that inflation line. You can do it because everyone else is drowning in it. Everyone else is getting poorer. So to keep your wealth is quite tricky. But to actually outrun it, now that's really difficult. In a period of low inflation, it's not so difficult to outrun it. But in a period of elevated inflation, it's quite, it really is quite difficult. So we're in that hard to get richer world, hard not to get poorer world. You've got to really be thinking and active to keep your wealth where it is. Because if you think about it, what happened during COVID was everybody got 10, 20, 30% on average poorer, because you can't take a year off and not get poorer. And the world took a year off and got that much poorer. China's in a state right now because it had the hardest of all COVID lockdowns. It had the hardest of all, stop doing anything environment. And that really knocked the stuffing out of China. And it will come back. But, we're in that period of comeback from that economic disaster that has been basically, cosmetically made to look less worse with inflation. And it's still going to take some time to come back. But that recovery, for people who can see it as a recovery situation, can spot the areas of opportunity within that recovery, can spot the places to actually protect themselves from this stealth inflation. That's really what people who want to not get significantly poorer have to do.
You did mention the fact that gold is, is at these all-time high levels, but on a nominal basis, on a real term basis, that may or may not be the case necessarily. Why the sudden move in gold, though? It appears like this rally is really kicked off the last couple of days. Broadly speaking, it's been rallying for a year now, right? But there's been this recent move in precious metals in the last couple of days. Well, what's going on? What's being priced in to the price of gold?
My perspective, I mean, I've never really been a gold fan, and I've bought significant amounts of it over time. When I got gold completely wrong with COVID, everybody was saying, oh, there's going to be deflation. And I said, what are you talking about? And I wrote this in Forbes, it's going to be inflation. I can't see how anybody can say it's going to be deflation. They're printing money like nobody's tomorrow. It's going to be inflation. And of course, the first chapter of How to Be an Investor says when there's inflation, buy gold. So I bought an absolute ton, not quite a ton, but I bought a lot of gold one way and another. And blooming thing didn't go up. In fact, it went down. And as somebody that's never liked gold that much, I was a bit bitter and twisted about that. But if you do trade, and as I used to when I had a stomach lining to actually burn off, you learn quickly. It's not what you think; it's what you see that you have to trade. It's not the same as investing. Trading is completely different, right? But when you trade what you see, not what you think. And I was looking at the gold chart and went, wow. And again, I wrote this in Forbes before it happened. So people can go back and go, I don't believe him. He's Captain Hindsight. But you can actually read it, dated articles. I said, if it breaks through this level, it's off to the races. And it breaks through the level and it's off to the races. And, you trade what you see. So I've been writing about gold being bullish. But ask yourself this. What's the point of gold? Now, you can come up with all sorts of long explanations. Oh, bloody, it's the real money. Oh, the Romans liked it. Oh, it's been ever since the beginning of time. Oh, it's real money. Paper is rubbish and all that. You do all that, but they're just words. What is the practical use of gold? Well, it's not in teeth anymore. So that's one usage that went the way of the passenger pigeon. People like jewelry, but they've always have. It's in electronics, and there's more of that, I suppose. They make, depending on how you count it, between 1% and 3% more gold every year than exists. Okay, so it's not as if it isn't an inflating asset itself. But why do governments keep buildings full of gold? Yeah, and there's a very simple answer. It's not a very happy one, but it's a very, very simple answer. Gold is for war.
Because governments don't trust one another.
Well, they're not going to take their paper in a war, are they?
Mm-hmm.
Yeah, gold is for war. That's it.
Is that where we're at right now? Are we on the precipice of a major war or wars? Is that why gold's been acting the way it has?
I think precipice is not the right word. It's a very good word. You can put that in your thumbnail. On the precipice, gold is on the precipice of war. It's great. People will click on that, and they should, because gold is for war. Gold isn't for anything else. The Fort Knox doesn't have tanks parked on it because gold is not for war. Gold is for war. Gold's never going to be money. There's not enough gold for there to be money. Okay, and it's an awkward money too. In the Middle Ages, the kings didn't like issuing coins to the peasants because the blooming peasants would lose it. They'd drop it in a field. All your gold's going to get lost. You want to keep it for big transactions. So they didn't have small coinage, for example. They didn't want to lose their copper to blooming peasants losing it in their fields. They didn't want that. They want to keep their copper for useful things. So anyway, it's the same still today with gold. Gold is for war. If you're in a battle, if you're one of the sides at war right now, no one's going to take your little printed pieces of paper with IOU written on it. No one's going to take your government bond. Are you going to take a Turkish government bond? No. Are you going to take an African government bond? No. If they want to buy something, they've got to back it up, and that's the dollar, right? So you haven't got dollars. You've got to pay with gold. Yeah, gold is for war. There's battleships at the bottom of the ocean full of gold. I mean, they dig them up occasionally. Yeah, I mean, because if England wanted to buy stuff from America, it'd pack a few tons of gold in a battleship and sail it to America, and then the equipment would come the other way. Yeah, gold is for war. Now we're not on the precipice of World War III. But let's just say that cliff edge is getting closer, or we are shuffling towards it. And governments aren't stupid. I know everyone likes to believe they are, but they're not stupid. So guess what? They're picking it up, aren't they? They say, I think we need a little bit more of that. Yeah, let's have a few more tons of that this month. Yeah, bring a little bit more of that in. Well, we'll print some paper and push it out there and have a little bit more of that gold. Oh, funny enough, China's buying it left, right, centre. Oh, I wonder why. Yeah, so you're going to get that sovereign, pardon my pun, sovereign pressure on gold and the gold price. And now, see, 6 months ago, I was looking at the chart and I thought, it's not going to go past, 2.6, 2.8. That's about the limit. on this chart on the upside, which is pretty good if you've got a fairly large amount of gold. But now it looks like it could go to 5,000.
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks, guys.
And of course, that's bad news. I mean, I don't care how much gold I've got. I don't want gold at 5,000. No, not in a hurry. I really don't. I like my life.
What's the silver side of the story? Gold is for war, but what is silver for?
Well,
and then really quick, in a $5,000 gold environment, what happens to silver as well?
Well, it's a good question. You see, I would say that silver moves in sympathy, but it's not what your governments are going to buy because it's not valuable enough bar weight. I mean, actually, as a little bit of a study of history, when the Americans were leaving the Philippines, they took the gold and they chucked all the silver in the harbor. They couldn't, they just threw it in the Manila Bay Harbor. And in fact, the Japanese got a load of American divers to dive in and fish it back out again, prisoners of war, because, they quite like that silver. But the gold, that went away. The silver, they chucked in the lake because it's just not valuable enough per weight. However, everybody goes, oh, gold's gone up. Oh, and therefore silver must go up. And because it's, in a sense, lighter, it's the penny stock of precious metals. It has that friability that can make it move. But, I'm actually more comfortable if silver moves alongside gold because it won't be governments buying it. And you would expect if there was an opening gap between the gold price and the silver price, then you should really start getting worried.
An opening gap in terms of what? I mean, the silver price?
The ratio. Gold-silver ratio. If the gold-silver ratio goes up, i.e. gold makes the move and silver doesn't really follow, that's a bad sign because that really is gold. Because, I mean, I don't know. I'm not ringing up Mr. Tsai saying, are you buying any gold, Mr. President Tsai? I'm not party to what all these governments are doing. But I do notice from various reports that, that there is this demand, and it's certainly China's picking it up. And you can imagine if they're getting caught picking it up, they're picking up a lot more than they're getting caught picking up. So, it makes a lot of sense. If you agree or you think that, what is gold good for? They're not making any more gold circuit boards than they were yesterday. Why is it going up? Well, there's the inflation pressure, of course, but that didn't seem to work 2 years ago. We are in this really tricky situation, globally and geopolitically, and it's getting more and more tense. You see, I'm not a doomster. I don't like to say, oh, it's all coming to an end. Buy bullets and corned beef and get yourself to Las Vegas and put some barbed wire around your caravan. I think that's ridiculous. And by the way, if you do want to run away from it all, don't go to New Zealand. You've got to go to Chile. Chile's the place that's furthest away from all this.
Chile.
But anyway, yeah, well, if you think about it, you want to be as far away from China as you can get, Russia and America. Well, that's Chile, isn't it?
That's true.
Not New Zealand.
Yeah, Southern Hemisphere is the way to go.
Yeah, well, they've never had any trouble. First World War, no problems. Second World War, and a little bit of a shit battle in the River Plate. That's it. Yeah, when all the Japanese had to do a runner, they went to Peru, and when all the Germans had to do a runner, they went to Brazil. So, they got plenty of time to think about it. That's where they went. Anyway, I don't have a place in Peru, and I always chuckle when I hear about people paying millions for places in New Zealand, which is probably not necessarily the smart place to go. But anyway, got plenty of sheep there. It's a nice place, mind you, New Zealand. So I'm not a doomster. It's just that the direction of travel currently is in that direction. And because of that, governments are going to be building up the gold reserves, and that's going to drive the price. And if it's governments doing it, the gap between gold and silver is going to go up. And if you want a contrarian pitch, and I really like this one, and it's not come to pass yet. It may not come to pass. You have to think about it. Platinum. Platinum's got the weight, and platinum's a precious metal, and you could pack quite a lot of that into your battleship, unlike silver. So, and platinum's absolute platinum, and palladium was $4,000 an ounce only 2 or 3 years ago. It's now $1,000 an ounce, give or take. I haven't looked at it recently, but that's where it was when the last time I looked. Platinum and palladium, but I like platinum. Platinum is a great metal. Is an interesting play on that, but keep it simple. Gold could go a long way, and all you got to do is look at a vertical, because bubbles just go like that, right? They just go straight up, and we're in that straight up move, and all you've got to do is follow that. And if it keeps doing it, that's what's happening. If it starts going sideways, well, you're in a different zone. So at the moment, this vertical that gold's on, which is, makes me financially happy, but makes me emotionally a little bit nervous and anxious, is if it does go that route, if we are going to see 2,800, 30, 3.5, 4, it's not good. It's really not good. I much prefer to live in a world of peace where the markets go up and give me 15, 20% a year. That's much nicer. I can't move all my wine cellar. I've got too many bottles. Can't get them to Chile.
Let alone all of your silver bars and all that other stuff. I mean, hasn't the gap between gold and silver increased though the last year? I mean, gold's making new all-time highs, and silver is kind of like stuck in his $30 zone.
I'm not saying it's not. I'm just saying that if that gap continues to open, it's a further negative sign.
I see.
If the gap stays the same, then it's not necessarily governments picking up gold for war. It could be that there's been a big lag in inflation moving through to the gold price, which I don't like that, because markets don't take that long. To take 2 years to come through into the price, that's I know these days with the central banks effectively cornering the markets, there's a lot of disruption and lots of disjunctions, and lots of things happen that shouldn't happen because the markets are no longer free. They haven't been free really since 2007. And, that gives room for markets to misprice and to have a lag in them. But really, there shouldn't have been, this price move shouldn't have been about the inflation of 2 years ago. I mean, it can be. I find the best way to make money is to have theses, have principles, and be able to change your mind and adapt to what the market is doing. So you have a theory, and if you're right, it will go your way. Yeah. And if you're wrong, it's not going your way. You have to keep examining your thesis to hold on to it to see whether it's going to go your way or not. And if it's, the market doesn't care what you think. It doesn't, you can't bend it to your will. If you're wrong, you're wrong. And if you're right, you're right. When I was a little kid, and I said to my father, I said, Dad, what, how does this all work? And he says, think about the market, son, is you only got, you wake up in the morning and you make your investments, you're either right or you're wrong. And that's it. There's nobody to cheat you. There's nobody to get in your way. You're either right and you're wrong. And if you're right, you make money. And if you're wrong, you lose. And by and large, that is absolutely the case. And so it's about being right overall. It's about having ideas and theories, and the market will test them for you. And if it goes your way, then you're on the right track. Not 100% right. All you have to be is 51%. And hopefully you're a bit more than that. But, with gold and what I see, and I just wrote that up, I think it's Seeking Alpha, or anyway, you can look me up on the internet. You'll find it soon enough. It'll take you 2 minutes. There's this vertical, and I think the article headline was "Beware the Gold Vertical," because if it really does go up that vertical, remember the dot-com boom, it just goes straight up. Remember Bitcoin, straight up. Remember Apple, straight up. We've all seen that hook, that hockey stick. How many times do we have to see that hockey stick to recognize it? Well, gold is doing one. And if it's not doing one, well, I don't mind really. But I mean, I don't care. As I said, I'm happy to give up all the money I'm going to make if it goes to 5,000, because, buying a yacht to sell to Chile is going to take all my profits.
Yeah,
So
hindsight is.
Go on, please.
Go ahead. Go ahead.
No, please.
No, it's because hindsight is 2020. If gold does do a hockey stick, we'll be able to see that in hindsight. But what's the telltale sign that gold is making a hockey stick right now?
You just look at the chart. There it is. I mean, it's not. I mean, there's no point in being Captain Hindsight. You've got to be Major Foresight, and that's what I try to be. And I see that chart. I mean, I got told off by an editor many years ago. Saying, you can't say the Dow's going to 18,000. You just can't say that. And I said, well, I have. And there it is. And in 6 months, it got to 18,000. I mean, that's how you make the money. You make the money by being right about the future, not being right about the past. And, charts, I've got a joke about charts, and you might even read it in some of my articles. I like to use it. See, you're crossing your arms. You see, even you're defensive about this position. I've got this thing that says charts are a great way to predict the past. Yeah. And there's actually a lot of value in that, even though theory often says there isn't. Because if you look at that gold chart, that beginning of that hockey stick is there. It's staring you in the face. The question is it going to do it? Yeah. Because it's not fate. But if nothing changes and that cycle is on, that dynamic is running, it has momentum, and it will turn that base of that hockey stick into that vertical. And it's begun that vertical. It's just a question of whether it is going to be that hockey stick or not. And of course, you could just sit there and watch it. And if it keeps on going on that trajectory, well, you're making money, aren't you? And if it stops going in that trajectory, well, maybe you're lucky that it's not going to go to 5,000. It's not fate. It's not fate. Somebody who's a major threat to the universe can fall off his perch tomorrow and it all goes away. But if that doesn't happen, yeah, and there is a dynamic going on, like there was in Bitcoin, like there was in the .com, like there was in Apple, and like there was on Nvidia, and like there was, etc. I mean, how many times do you have to see that chart to not recognize it? Apparently, a lot of people don't even know it, don't even look at it, don't even look out for it. But if you look at those charts over time, see them time and time again. Hockey sticks, they're like fish hooks, the little bowl at the top, and then they go up like that. And who knows how high they go? It's very, very, very difficult to get the top of these things. But when they're on the way, they are on the way. And I've made a lot of money over the last 25 years getting those early. Because Stoke could say, oh, look at that hockey stick. Oh, look, it's going to go for... Oh, no. You want to get it at the beginning. And when that form starts to be created, then, it's telling you something about what makes that happen. What hell could cause that? It's like Bitcoin. What could cause that? Well, it became evident. Yeah, and the same with Nvidia. It became evident. And the same with Apple. It became evident. In the end, although I was not an Apple fan 10 years ago, but you can see those chart forms build, and they're built from the machine, but you don't see. How many people knew Nvidia was going to do what they did with their GPUs? I mean, they're for computer games after all. What use could they be? Oh, whoops, cryptocurrency. Oh, they're useful for that, are they? Oh, okay. Oh, whoops, they're good for AI. Oh man, amazing. But if you've been following them and you've been following Bitcoin mining, when suddenly Bitmain, the Chinese mining company, started to talk about using their mining for AI, you'd have known that. Yeah. And then you'd understand why their chart went off the dial.
Can we infer a similar thing with the gold miners in relation to gold as we can with gold's relation to silver as well? Meaning that if gold continues to decouple from silver in the same way that gold may decouple from the gold miners. The gold miners they've had a decent year-to-date performance, but they haven't really overtaken gold.
Terrible. Look, I wrote a book called The Twain Maxim, okay, which is about mining companies and the whole mining sectors of places like Canada and Britain. Yeah. And the Twain Maxim is a mine is something with a fall at the bottom and a crook at the top. Okay. And as far as I can make out, I'm sure these gold mining companies are run by saints. But I cannot match because it used to be the old thing. Oh, yeah, so gold's going to go up. So buy gold mines because it's like a leveraged play on gold. Oh, yeah. So if gold's going to go up 20%, gold mines will go up, 80% because they've got their margins go through the roof and those small, all that toffee. Well, they didn't, did they? But why was that then?
Nope.
Why was that then? What happened? Oh, excuses. Oh, my hole's not so deep. Oh, my costs went up. Oh, this, that, and the other. Oh, rhubarb. All that sort of rhubarb that comes out of mining companies for the last 20 years. Oh, well, prices are down. How come you're doing okay? Oh, rhubarb. Oh, prices have gone up. How come you're not doing so much better? Oh, rhubarb. So you gotta end up saying, well, I mean, I don't understand how this is working. I don't want anything to do with them. And that's how I feel about gold mines. We hedged it all. Did you? Oh, right. Etc. Etc. I know. A gold mine is one of those things you can buy a gold bar, grind it up, chuck it in the hole, lift it out again, say you've got gold, say you've got a great gold mine. And it wouldn't be the first time someone had done that. So there's so much going on that is hard to explain that, I've given up bothering with gold miners. And buy the gold stack. I mean, I'm a gold stacker. My gold position is a part of a diversified portfolio of risk, which means you stick 2.5% of your money in gold and you just keep buying it. Well, if you're getting richer anyway. So I just keep buying it and I keep stacking it. And that means I've got an interesting stack of it in a vault in Switzerland. And that's why I like it. And I'm not a believer in gold. It's just a great thing to diversify your portfolio with because it is one of those things. I mean, it's not uncorrelated really, but it's a good other thing to have. So I'm a great believer in diversification. I don't know how people sleep at night not being diversified. And if you're a good, solid investor and you build up a good, solid portfolio of assets and a good spread of risks, then you're going to do really, really well. And gold is absolutely great. In the same ways, you would have a little bit of crypto. 0.5% of your value in crypto and 2.5% in gold, 5% if you love it, 10% if you're wild for it. And, you just keep stacking it, dollar cost averaging it. And, you start young and by the time you're old, you're looking at it thinking, wow, that was great. Where did all those years go? Where did all that gold come from?
What about any the other commodities out there? We've seen a pretty rough time for the commodities ever since they topped out in 2022. At the same time, the broad markets continue to rip higher. When can we expect a capital rotation out of, let's say out of the broad market into commodities at some point? Where if you look at like a chart of the commodity index, relative to the S&P, it's super cheap.
Again, I have perhaps a bigger picture view on it. You see, coming out of games, I think of things in game theoretical perspectives. So there's three sorts of games. Okay, there's a negative sum game where if you put down $1 in the game, you come back with 98 cents, and if you keep doing that, you end up with naught. Okay, there's a zero sum game where you put $1 in, you're going to get $1 out roughly, and sometimes you get 101 out, 103 out, but sometimes you get 98, 97 out. But basically, if you play that forever, you're going to get nowhere. And then there's a positive sum game where there's money coming to the table. So you're playing the game, and every time you play, you're winning a little bit. Okay, that's what a casino plays. It plays a positive sum game. Its odds are in its favor. Okay, now that is the only game to play. Don't play a negative sum game, and people twist themselves to all sorts of rationalizations of why they should carry on doing that. It's like poker, 10% rake. It's a negative sum game. I don't care how good you are, you're going to lose all your money. Well, 99.999% of people are going to lose all their money playing that game. If you play a game with a positive sum game, then you pretty much can't lose. So if you had played the positive sum game with the stock market, bought the S&P 500 tracker whenever it came out in the, was it 70s, 80s, whenever it was, it just bought a dollar cost average that every month, you look like a genius because you're playing a positive sum game. Now, as far as I'm concerned, there's only one positive sum game out there, and that is stocks. Yeah, commodities is a negative sum game, currency is a negative sum game. I mean, property is a positive sum game because they're not making any more land and there's more people. So that's a positive sum game. So first of all, find your positive sum game. Yeah. Even if it's a zero sum game and they bring you sandwiches or give you player points or Bloody Marys or whatever, at least you get fed. But make sure you're playing a positive sum game, because if you're playing a negative sum game, you will lose everything. It's your fate. Yeah. And look at the game you're playing and make sure it's not a negative sum game in some way that you haven't worked out yet, because there's some crafty swine in there chipping away at you. So you're actually playing a negative sum game. So stocks is the only financial market that I consider to be positive sum game. Now, you can make an argument for commodities, not really. And people always make, oh, options, ha, 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 ha. You should, ha, ha, so much money to be made. Oh, and so on and so forth. Yeah, so stocks is the only positive sum game to play. So only play stocks. Yeah, unless you're an absolute blooming genius and you've got a PhD in maths, and then you might be able to turn some of these funny games into positive sum games. But funny enough, how many of those professors of maths end up going down the toilet when the market suddenly rips their faces off? The history of all these banks are having buildings full of PhDs who suddenly bankrupt the bank. Yeah. But stocks have been, over the years, the best place to find positive sum games. So they're the game that I play. And commodities, if you're a gambler, there is a way to play it, okay, at the moment. And that is, in these sort of markets, every commodity has its day. And I believe it's orange juice recently. Futures in orange juice. What a fantastic game. So, I think it's pork bellies about 9 months ago. So every commodity in these inflationary times will have its hockey stick. And if it hasn't had one, stake it out, watch for the hockey stick. And when it kicks off, get in and then get out quick. But that's just a trade. That's just a gamble. But they all do that. And, you've had nickel, you've had copper. We're having gold right now and silver. And hopefully that's just one of those things. And it's not the end of the world. Yeah. So if you want to trade, if you want to gamble, it's gamble. If you want to gamble, you want to lose leverage, you want to, get rich quick or poor even faster, then that is a strategy. Because if you're looking at the markets today, they have an echo to the 70s. And in the 70s, every one of those commodities had its day. And if you really, really do want to suffer, you can look for the kind of echo of each one of those hockey sticks, because they go up like crazy and they go mad and wild. And what was it, cocoa, a chocolate a few months ago, and then they come down like a rock, up like a rocket, down like a rock, and then in about 2 or 3 years they do it again, but not as much, like a third. But they kind of try to do it again. They try to repeat history and they fail. And that, if you're into commodities, is what I would be doing. But now it's better to just trudge along, building up a nice portfolio of excellent companies and getting rich slow.
It sounds like that's what happened with natural gas, right? And as well as coal.
Perfect example of one of those up like a rocket, down like a rock. And, even professionals get broken by that market. So why would you? I know why you play it, because you're a gambler. You like the adrenaline, you like the dopamine, you like the endorphin from the pain. You like being rescued from certain destruction at the turn of a hat. Apart from when it doesn't happen, you get wiped out. Oh, who needs the margin calls? Come on, I mean it's people. Look, go to Vegas, places full of people throwing their money away. And they all say they're winning. So anyway, not many people are in the markets to make money, unfortunately.
Yeah.
Which actually is fortunate for people like us, because we are. And it gives us more room, because if you're sensible, rational, and you work at it a lot and you study, you'll do very, very well. If you gamble and gossip and, run around like a headless chicken, you will do very poorly. And a lot of people do.
Totally true. Well, we alluded to some external factors with the price of gold potentially being the reason as to why it's moving up, i.e., war and conflict all over the place. Let's talk about another externality, which is the U.S. presidential election. Do you see any? What are the potential impacts between a Trump versus a Kamala presidency to what it would have on the markets?
Well, I mean, what a shower, as they would say. What a complete shower. But if you can get past all the emotional roller coasteriness of it all, the I don't know, the world turn game show or whatever reality show, can get past that, you have to say that the Democrats haven't exactly been bad for the markets. And there's a reason for that. And that reason is, well, first of all, one of my favorite kind of maxims, the Clem maxim, is that invest alongside the government or people in government. Yeah. So people in government, where's their money? Well, it's in the house, and it's probably in a 401k in stocks. Yeah. So they're not going to break that. Well, I don't know. If anybody can wreck everything, it's them. But, that is where they live. And they really, really, the thing that most of them are all they think about is their pensions and their retirement. Yeah, that's in public service. That's what most of people in public service are thinking about. When do I retire and get out of this? Yeah, and their money's in their pensions is in real estate and in equities. And so that's, when you've got them by the wallet, the heart and mind will follow, to paraphrase a German. And so I think you're pretty safe in a way, financially, or thinking about where their financial interests are and putting your money there. Now, there's another good reason why equities and real estate is a good investment, or has been a good investment. Who knows about tomorrow? And has probably got a good reason for it to be good in the future. And if you want to pump money into the economy, if you give it to the poor, you create inflation. And that's one of the reasons why you got it during COVID, because they handed out money to the people that needed it. And guess what they do? They spend it. And, not only do they need to spend it, they like to spend it. So not only do they like to spend it, they need to spend it. So if you hand out money to the people in need, it generates demand, and that generates inflation because the supply can't respond that fast. But if you want to put money into the economy and you don't want inflation, you've got to do it another way. And the way you do it is you pump it into stocks and you pump it into real estate values, because that goes to the rich. And the rich don't need money. They've got it. They want it. Who doesn't? But they've really not got a use for it. So what do? They buy another house and the house prices go up, or they stick it in the bank and the bank lends it out. And that way it trickles down at such a speed that it doesn't make inflation. Yeah. So that's why QE didn't make inflation back in the day, because it went into illiquid assets rather than into liquid spending. Near where I am right now, during COVID, they gave nice handouts to everybody, and all the people who were not well off went down the supermarket and bought out all the hard liquor, because before that they could only afford wine and beer. But the moment they got a nice handout, they went and bought out all the hard liquor. So you went down the supermarket and all the hard liquor had gone. Yeah. And that's an example of why you don't put money into the economy that way. Because your Jack Daniels goes up and your lettuce goes up, and your potatoes go up, and your prices go up because it immediately gets spent. But if you give it to the rich through inflating house prices using monetary policy and equity prices using monetary policy, it doesn't explode into your economy and cause inflation. And if you're a politician, you can say, well, it's fair. Anybody can buy $100 of shares. You can buy the S&P 500 $10. You can do it with Robinhood. You can buy an index tracker. Anybody can buy that. And anybody can try to buy real estate. Most people can buy real estate. Everybody's got an entry level into real estate too, or certainly did anyway. And so it's fair. Anybody can join in the party. And if they don't want to buy stocks and they don't want to buy real estate, well, bad luck to them. So that is the mechanism of supporting economists these days, is to push the money into less liquid assets. So if you're looking at the way that the Fed has been handling liquidity, as they call it, which is in the old days, they call it cash, right? Is to take illiquid assets and push them by their monetary policy towards cash. So you basically make all sorts of money that's not dollar bills more like dollar bills, so that money becomes more available and the flow of money stimulates the economy. And when you want to slow down the economy, you take that cash and you push it back into less liquid assets that are harder to spend. And you cannot go down to the supermarket and buy a bottle of whiskey with a treasury bond or any other instrument, or even your CD, even your your money funds. It's not cash, it's near cash. So that's how they try to maneuver the market between inflation and contraction and expansion and inflation. And the best way to expand an economy without inflation is to pump the money into illiquid assets that then kind of dribble down. And that's what they've been doing, and they'll do that again. So there's a kind of copper bottom under stocks, and there's a kind of copper bottom under real estate, although it's over an extended period of time. It's a patient money thing. And so, that is, I just like stocks. I mean, I love stocks. Stocks have been very good to me. And, that is the best place to be. Everything else is probably at very best a zero-sum game. And actually, so many of them are negative-sum games, because the reason Wall Street is Wall Street is that they provide you with these negative-sum games to play. They're the casino. They take their piece. You pump your money into their bank account. And, that is not a game you want to play.
Before we wrap up, guys, I'd like to remind you to hit that like button, smash the subscribe button, comment down below. Go Clem, go if you enjoyed this interview. But if you disagreed with any of Clem's takes or my takes, let us know in the comments down below. Really interested to get your insights here, guys. And of course, I'd like to remind you to check out our Substack, capitalcosm.substack.com. You'll find the full version of this interview in our Substack. So to get the full experience, you're going to have to check out the Substack. Link to that is down below in the description box, as well as the pinned comment. And with all that said,
Danny, you didn't tell him to ring the bell. You got to ring the bell.
Ring the bell. Thank you, Clem.
My pleasure.
All right, guys. Well, I'll catch you in the next episode.
I've been saying that within 5 years, oil will be $300 a barrel. Yeah. And people go, what? Why? What? No. But if you take a big picture, and some people, there's a thing about AI. And the thing about AI is energy. I mean, literally, you make AI with energy. Energy equals AI. All these GPUs, or whatever they're called now, that they're not, cranking computer games, and now they're not cranking Bitcoins. They're just short circuits that generate heat. That's why half the difficulty with running AI, you should make so much blooming heat. You melt